Good day, family. Welcome back. Coach Jake on sum up the last two videos we talked about in one video. I'm gonna just give it to you real quick, and hopefully you can receive it. First of all, if loved ones are dependent on you, and you're not at your point of financial freedom, I call it being self-insured, where you got enough money passively for them to live off of, or for even if you're still living for you to live off of. You can now call yourself self-insured because you got enough money to take care of your lifestyle, whatever that is. They say, for instance, you're a single parent. Once again, you got a 10-year-old child. You want a 10x, at least 10x that insurance policy, say up to $1 million and maybe beyond that, so that that person can live off, continue that lifestyle that you were used to giving them at $100,000 a year when you were here, and now you're gone. They can continue to live off that $100,000. Make sure it's in a trust because that child cannot touch that money until they turn 18 years old. Number two is you're in pursuit of purchasing a home. Go ahead and purchase that home in your name only. Why? Because in the point of somebody uh, receiving this home as a beneficiary from you once you pass away, guess what? It's called a step up in basis. Once again, if you purchase a home $200,000 and by the time you pass away it's worth $1 million, guess what, family? They won't have to pay any capital gains tax on it. So check that out. So once again, with the life insurance, once again, make sure that child is under 18 years old. It's got to be in a trust. It's got to be in a trust because that trustee can now get that money and make sure that child continues to live their lifestyle. Otherwise, that child is not going to be able to receive that money until they're 18 years old. I just experienced that. I told you guys that in the last video. And once again, just like with the home deed, go ahead and make sure it's in your name only, and of course, you're going to will it over to your spouse. I mean, that's probably a no-brainer. I guess, I don't know. But life insurance, you can put anybody on there. It doesn't have to be the spouse. But when you got this home deed, your spouse, you all talked about it's in the will and all of that. You make sure that it's not in the other spouse's name. At the point of your demise, they receive a step up in basis, no capital gains tax on it. So, say for instance, they didn't want to stay in that big home anymore and it's worth $1 million now, they can get $1 million tax free, penalty free, all of that, regardless of the age. The last one I want to talk about, once again, we talked about the mortgage life insurance where you get $200,000 house, you get $200,000 mortgage life insurance on it. At the point you pass away the next 30 days, guess what? That mortgage insurance will pay out that house. Just think about it. You got to pay for a house. You got life insurance that's coming in for X amount of years. And now, this is the next one I want to talk about. The last one, PMI is making sure if you're purchasing a home, when you go to purchase it, put at least 20% down on it because now you get past PMI, you won't just want to give money away to a private mortgage insurance, and just put 20% down